Michael Burry, famous for predicting the US housing collapse that drove the 2008 global financial crisis, believes that the stock market is doomed to repeat a key mistake that was made during the 1970s inflation crisis. A mistake which resulted in negative real returns for almost 20 years. And a mistake that seems to be repeating itself given some of the decisions made by the Federal Reserve in just the past couple of weeks. And considering Burry has made a number of accurate predictions this year, it's worth breaking down his latest thoughts at the very least to deepen our understanding of how the economic machine works to better prepare ourselves in the future. As usual, Burry shared his thoughts in a short tweet which he deleted just a few minutes later. Fortunately for you, all I do these days is go on Twitter, so I was able to screenshot the tweet before he deleted it. Okay, not really, but today I am going to be comparing what happened in 1974 that led to real returns continuing to decline and compare it to what is happening today. If you enjoyed today's video, I'd really appreciate it if you could hit the subscribe button and help me get even closer to hitting 100,000 subscribers, which we're getting very, very close to. This video is sponsored by SHARESIGHT, a comprehensive portfolio tracking tool that automatically tracks the performance of your investments so you can say goodbye to Excel spreadsheets forever. Use my referral link in the description below or head directly to sharesight.com/Hamish Hodder to try SHARESIGHT for free or receive 4 months of a yearly subscription. Burry's latest tweet starts by referring back to 1973 and 1974. He makes mention of how markets reacted positively in December of 1974 to the Federal Reserve's decision to cut interest rates back to 7.75%. Burry calls this a killer mistake, and to understand why, we first need to know what happened leading up to December 1974. The period between the 1960s and early 1980s is known as the Great Inflation, where the consumer price index in the US rose from a healthy 1 to 2% to almost 15% in 1980. And between 1968 and 1982, you can see that inflation never dipped below 5%, which is more than double what most economists consider a healthy level. There were a number of factors that caused various spikes of inflation during this period, but it all really started after World War II and the introduction of Keynesian stabilization policy.
We have nothing to fear, honestly nothing. There's no danger of the exchange falling too far. There's no danger of a serious rise in the cost of living.
John Keynes is one of the most widely recognized economists of all time and is responsible for much of the fundamental economic theory that guides central banks and governments today. During the Great Depression in the 1930s, Keynes recognized that consumers and businesses were saving money and hesitant to spend in the hopes that the recession wouldn't last very long. But it was exactly that behavior from people that prolonged the 1930s recession due to a lack of economic activity. Keynes argued that it was the role of government to stimulate the economy, which eventually happened with President Roosevelt introducing the New Deal, a relief program.
Roosevelt made it clear that he would be president of all the people, including those at the bottom of the economic ladder.
Essentially, the theory was that the government through fiscal policy and or the central bank with monetary policy could stimulate the economy, ultimately reducing unemployment, and the consequence of that would be a modest increase in inflation. And while this theory does have a significant amount of value and use cases in modern societies, and as I said, is still used by governments and central banks today, Keynes didn't live to see the period in time, especially in the United States, where a large problem of this theory would show itself. The problem was that the relationship between the unemployment rate and inflation wasn't one that was stable and that could be relied upon over certain periods of time. In 1968, another economist, Milton Friedman, warned that relying on this relationship would lead to businesses coming to expect inflation and then to act in anticipation of it, ultimately requiring higher inflation to keep unemployment low. However, the negative consequences remained relatively unseen for most of the early 20th century, and this was because beginning in 1944 and until 1971, the US dollar was still linked and backed by gold. At this time, the Federal Reserve actually held gold reserves, and you could exchange your US dollars for gold. This meant that during this period, it actually wasn't possible for the Federal Reserve in the US to enact some of the policies that Keynes suggested. But this all changed in 1971 when President Nixon severed the link between the US dollar and gold. The full inflationary potential had been unlocked. During the early 70s, the government legislated a number of large spending bills which went on top of the fact that the US government government was already spending a huge amount for a number of other things, including the Vietnam War. Then in 1973, a huge supply shock in the form of an oil embargo drove crude oil prices to quadruple and remain high for a number of years. This plunged the US into recession, and the Federal Reserve had the difficult job of deciding between raising interest rates to curb inflation, which would have put the US into a deeper recession, or to lower interest rates, which would have eased some of the economic troubles, but would have allowed inflation to run even hotter. This is a period called stagflation, a combination of economic stagnation and high inflation. I have a video breaking down Ray Dalio's explanation of stagflation and why we're seeing it once again today. I'll leave it linked down in the description below if you want to check it out after this video.
Yeah, we are in stagflation.
We are. Stagflation is simply where, you have inflation, and yet at the same time, you have high unemployment.
Yeah, you have economic weakness.
Right.
In other words, you have a stagnant economy. Stagnant essentially means
meaning growth is reduced.
Low growth, and with high inflation. And that happens through this monetary situation that I'm describing, in which the central bank tries to deal with a middle course.
The Federal Reserve in 1973 began doing large interest rate increases to stop runaway inflation, initially raising interest rates from 3.3% to 12.9% in mid-1974. As Burry indicated in his tweet, this drove a 46% decline in the stock market. Then the Federal Reserve began lowering interest rates, eventually dropping them to 4.6% by 1976. The decline in interest rates, along with inflation slowing from about 12% to 5%, drove a 50% increase in the stock market over just a few months. So why was this a mistake? Well, the easiest way to understand why all of this was a mistake is by simply looking at what happened to inflation in the years that followed. While inflation did initially decline, it remained above 5%, far exceeding the healthy 1 to 3% range, and within a few years it continued to climb even higher than before. Plus, the stock market was essentially going nowhere during the late 70s, and when adjusted for high and persistent inflation, the market was in decline for over a decade. All of this only ended in 1981 when the Federal Reserve finally got on top of inflation by raising interest rates all the way up to 19%.
And there was always this conflict, which always exists. Don't tighten monetary policy too far, you'll get some unemployment. So we went a decade that way, and we got more inflation and more unemployment. It was obvious that existing policies weren't working. But I decided we had to change an approach, and we got to stop worrying about increasing unemployment at any time. We got to deal with this inflation, or it's going to get worse and worse.
Following this, inflation declined below 5% within a couple of years, and adjusted for inflation, the stock market resumed growth. Unfortunately for us, many of these same mistakes that were made in the 70s are being made again today. We've just come out of a pandemic which required a historic amount of government spending and easy monetary policy. Then, starting this year, the Russia-Ukraine conflict has resulted in a huge oil shock, which has spiked inflation to over 9%. And similar to the 1970s, the Federal Reserve reacted by raising interest rates, the stock market then collapsed over 30%, and the US entered a technical recession after 2 consecutive quarters of negative GDP growth. But despite inflation almost being at 10% and actually accelerating, showing really no signs so far in the data that things are slowing down, the Federal Reserve is already hoping to slow down their interest rate hikes. The Fed is looking to do a 50 basis point increase in interest rates next month, which is already a slowdown from the 75 basis points that they did this month. The slowdown in the Federal Reserve's rate hikes, while inflation is still well above a healthy range, is the mistake that Michael Burry believes that we are repeating today. The reason for that is relatively simple. If the Federal Reserve does not get on top of inflation and begins to ease, and inflation gets worse, then it's very likely that even harsher interest rate increases, like in the 70s, they had to go up to 19%, it's very likely that harsher interest rate increases will be required to get inflation under control, and that ultimately means leading to a deeper and worse recession when interest rates rise, because that's going to be a substantially larger increase to the cost of borrowing to individuals, to the government, and also to businesses. And from an investor perspective, allowing persistently high inflation means that even if the stock market is going up in nominal terms, in real terms, stock market returns could be negative for a very, very long time.